Good morning and welcome to Purpose Driven Finances, where our focus is helping you use your finances to achieve the purpose and plan for your life. And now here's the host of Purpose Driven Finances, Allan Malina with Servus Capital Management.
Hey, good morning. This is Allan Malina, your host, Purpose Driven Finances and president of Servus Capital Management. It's been a glorious week, folks. How have you been doing? I'm sitting here with my co-host, Rich Roth. How you doing, man?
I'm good. I feel better than you sound.
Yes, sir. I'm trying out for a new radio show.
Yeah?
On K92. The Night Hour with Wolfman Jack.
Got a little of the bug going around.
Yes,
huh?
sir. I all the week long I had the flu, and came in and taped on Friday, and I don't have any symptoms except for I just sound rough, and I wouldn't have come in. I would have, done it through. Thankfully, we've never had to do that. Do an AI,
an
AI or a meeting. What is that? Google Meeting or whatever it is. Yeah. So thankful for that. But Rich, it's been an eventful week. It's been an exciting week. So let's cover the week. And I don't have much fluff because I worked from home. The reason I worked from home is one of the listeners that we communicate a lot with. He was like, "Allan, just work at home. You don't have to pay any fees for real estate." But having a firm outside of your home is a whole lot better. Did you know, Rich, when I got audited this past year in 25, the auditor that came to my office said like 60-70% of RIAs in Virginia work from their home.
Is that right?
I was like, can you imagine that?
Like, don't even have an office,
yeah.
Or they have an office, but they work from home?
No, that they work from home.
Wow.
And he said they just meet outside or at people's houses.
Mm-hmm.
And I was like, well, that's got to be awkward for you. You pull in and you're at their kitchen table,
right,
doing the audit.
Asking your wife, "Hey, can I have some pancakes?"
Right. It would be really awkward if you found something really bad and you got to be like, "Hey, we got to arrest this dude."
Yeah, that would be awkward.
Or something.
Hey, you may want to go change out of your pajamas,
right?
Because we're going downtown.
Yeah, we got to go somewhere. Because that's happened sometime in the world, in America, at some point. But that being said, the reason, I don't know if you knew this, Rich, but as a registered investment advisor who owns the firm, we have to have something called a contingency plan in case something happens at the main office where it blows up. What I mean by blows up, that's a very, not a very good, I'm being lazy in my words. If the power's off, if there's a fire, I have to be able to operate somewhere. Mm-hmm. Because if you're going on vacation and you need $5,000, I can't say, sorry.
Wait till I get back.
Right. And in Derecho, power was out like 2 weeks almost. Mm-hmm. So I had to go somewhere. So what's interesting is if I have to have a completely similar system at my house that's on a different internet, but then if it's out at the house and at work, then I have to go hot tail somewhere else. And I have to have a complete system to go there. So I pay for 3 internets. And just let people know what's happening. Because a lot of times people are like, well, Allan, if you can't do this, or what is really the process? So I figured I'd just share that. So, Rich, I know you're busy doing all kinds of things for James River Media this week. CPI came out, and it actually came out on, I believe, Friday. And I went back in the archives, and I was wondering how accurate we were about the results.
So CPI, Consumer Price Index.
Yes, sir.
Why is it so relevant to people in the audience right now?
The reason it's relative is because basically money managers and what happens in your investments a lot of times is dictated by what happens with CPI. As an example, we'll get into it, but CPI, there was some prognostication forecasts that said it was going to come in hot. Market sold off. Because if CPI comes in very hot, then the Fed's not going to lower interest rates. If they don't lower interest rates, then what happens is the housing market does not recover. If the housing market doesn't recover, then people don't need to go shopping at Lowe's and Home Depot to fix up things in their house. And so it's a cascading effect about what's happening in the real world.
Okay.
And so on January 17th, I said that the numbers coming out this month would be between 2.37 and 2. I mistyped. It should be 2.59. And 2.37 to 2.59. Well, guess what, Rich? It came out a whole lot less than all of those. I believe it came out at 2.3%, which, or 2.39. And 2.39, and I said basically 2.48. So was I accurate? Well, not really, because the clock is accurate twice a day.
Well, you had the range. It was in the range.
It was in the range, but a range doesn't do much for you. Because if it came out at 2.6, that means inflation's going up. 2.39, it means inflation's going down. I said 2.48, 2.5. So what did it do for you? Not a whole lot, because, we got the intent, but we didn't get the actual number. Now, point number 2, and I wanted to bring up a competitor. No, I'm not. Come on, bro, Allan. It's not a competitor of yours. J.P. Morgan. It's not a competitor. Come on, man. Don't even try. They probably have financial advisors who are worth more than I actually manage. They probably do. Jamie Dimon, he is the only banker who didn't create a bank that's a billionaire.
Is that right?
Mm-hmm.
Wow.
It's pretty impressive. And what he's done with J.P. Morgan is impressive. And he, is he a Democrat or a Republican? I don't know. He really works the fence, from a political standpoint.
Yeah, he got to.
Yeah. That being said, what happened on Thursday is part of their division came out with a forecast of CPI the day before. And normally if a big bank comes out with a forecast the day before, you would expect it to be really accurate. It was about 10:30, 10:45, 11, sometime in that range. It didn't hit CNBC until, I think, 12:15, something like that, because it takes a little while from internally to go externally. And what happened is they came out and they basically said that the forecast on a monthly basis was a 0.39%, which they said that they expected it to be hawkish. Allan, what does that mean? See, I'm playing like I'm rich.
There you go. What does that mean, Allan?
Yeah, thank you. And basically, they said that if it comes in hawkish or hot, they expected a 1.25 to a 2.5% decline in the stock market. So guess what? And they said that it's going to come in hot. So guess what happened to the stock market from like 10:30 on?
Tanked.
It tanked. Not only did stocks tank, but bonds, I believe, went. Some bonds actually went up in value, but that was because of fear. Gold and silver tanked. Everything tanked. International countries tanked. What I mean by that is companies in international overseas, they tanked. And the biggest reason being is because they're like, when I say they, the market was like, if J.P. Morgan's coming out less than 24 hours, they must know something. And so they came out, and guess what? They were way off.
Mm.
And so, Rich,
what's the lesson here, Allan?
Dude, you're on top of it. The lesson is, when it comes to forecasts, take them with a grain of salt. Because look, mine a month ago was in the range, but it wasn't accurate. J.P. Morgan's was less than 24 hours, and it was way off. So what happens if you take their forecasts and 100% go with it? The issue that you have there is it can dramatically affect your portfolio. Because like yesterday, Rich, if you had sold everything and reacted in a negative way on Thursday, if you had not have made any changes, then you would have recovered some. Because like the S&P 500, I think, was down like 1.55% on Thursday. I think before taping of the show, it was up like 0.5, 0.6%. Still not a good trend, but you shouldn't react just because of a forecast unless they have a highly accurate forecast of where it's going. That being said, I'm going to give a forecast. Not really a forecast, but where my system, and I've talked about the QPM, and I've talked about how the QPM in the past, we struggled, for about a year and a half. And what I'm trying to do is communicate that if there's a system in place that is actually accurate and can be back tested and can be proven from price volume volatility, and there's an actual model, then what ends up happening is it can help you. On Wednesday, part of the math said that there's a changing quad. And what that means is we were going from a quad 1, quad 2 to a quad 3. Quad 3 is basically where inflation is going to go flat or tick up a little bit and where the economy is going to slow down a little bit. So what's going to be interesting is the second quarter of this year, we're expecting a quad 4. What does that mean? Well, the first quarter, the GDP is probably around, I didn't review it, so I'm kind of on the tip of my surfboard right now. But I believe we're looking at like 3%, 2 and 3/4, somewhere in that range. The second quarter, we're expecting like 2.4. It's basically, I know the differential between the two. I don't remember the exact numbers, but it's basically a 25, 24 basis point drop. It's not significant. It's not going to be dramatic, but it is a slowdown. And that being said, what ends up happening is things are changing. So on Tuesday, all portfolios got hammered on Thursday because everything got sold. But what ended up happening was on Wednesday, it said to get out of small caps. Small caps are still doing well today, on Friday. But get out of technology, get out of various areas where it has a lot of market sexiness. I know that's a very good financial term. Rich.
Yes, that's beautiful.
People can really use that. But it basically, to move to defensives, get out of financials, get out of technology, and reduce your broad indexes. As an example, so we got into real estate, we got into utilities, we got into staples, we got into healthcare. On Friday, Rich, at one point, I believe utilities were up 2.4%.
Wow, it's a big move for utilities.
It is. And if you were to look at a chart of utilities, it's crazy. So, folks, what I'm saying is have forecasts, listen to forecasts, but make sure someone has a process in order to really determine what it is, not just what they think, feel, or believe. Because in the CPI, I pay for a model. I don't actually track a model. I was communicating what I pay for. But I have a process that tells me about where the cycle is, where the investments are going. So when you're talking to your advisor, when you're talking to whoever you're getting your information from, make sure they have a process to help you navigate the changes. So, folks, stick around. We're going to go for a minute break. Give me a call at 434-316-0246. We are going to talk about retirement plans and how you can effectively manage yours to get the most out of it. I'll catch you on the flip side.
It's Brian Kilmeade.
Evidently, they not only have a lot of them, natural resources, but they've been hoarding a lot of it too. By far, double the second most who's been hoarding in Vietnam, then Brazil, then Russia, then India, then Australia. We need it. But let me ask you, why are we not in the Congo? Why are we not cutting a quick deal with Ukraine? Why are we not in Minnesota getting our own rare earth? It's national security. You can't tell me there's not reason now to go ahead and do it.
The Brian Kilmeade Show, weekday mornings from 9 to noon on WLNI.
Hi, I'm Vince Gallane's host of The Vince Show and Vince Podcast. It's a show with an obsessive focus on what's good for America. I'll give you the truth beneath the headlines of all of the nation's top stories, and I'll bring attention to the stories the legacy media want you to ignore. We feature newsmaking interviews with the top guests on the planet. I'll ask the questions you can only dream of other interviewers asking. And of course, I'll take your calls from sea to shining sea. The Vince Show and Vince Podcast.
weekdays from noon to 3 on WLNI. And now, back to Purpose-Driven Finances. Here's Allan Malina with Servus Capital Management.
Hey, good morning again. Allan Malina, your host, Purpose-Driven Finances and president of Servus Capital Management. Sitting here with Rich Roth, just talking about the markets, talking about your portfolios. And you know what, Rich? You reminded me during the break, I totally forgot to bring it home to where you feel really at home and comfortable, the sports show.
That was a lifetime ago, Allan.
Yeah, exactly.
A lifetime ago.
But, Anthony, he pulled it up for us, so let's use it. And there's a reason why I have it, Rich.
Okay, good. I'm glad to hear that.
And it'll be very applicable.
Because I did have to double check. I'm like, you're sure this is the right one?
Right, exactly.
Okay. You ready?
Ready, go ahead.
Your performance today should go down to one of the best defensive performances in history. Did you know that they were going to use you as versatile as you were today?
Well, of course I did. They asked a lot of questions pre this game, before this game, and I told them I can't lay the game plan out to the media, but I kind of knew what was going on. We had a good tell on what they like to do and how they like to play and how they was going to attack us. So you talking about a coach who put us in the best position to win? That's our coach right there, and that's why we stand beside him, and that's why we always going to have his back.
Rich.
Yes.
That was Devin Witherspoon.
Uh-huh.
And I don't know how much sports you follow now that you don't do the show, but there was some flurry because he was being interviewed right after they won the Super Bowl. He was from the Seattle Seahawks. And he said that we had some good tells.
Mm-hmm.
And he said we knew a lot of what they were going to do.
Mm-hmm.
The reason I wanted to share that is in the QPM on Wednesday, we had some good tells that there was a regime shift occurring that we need to get out of certain aspects of the market and shift to others. Because if we had stayed there, then what would have happened on Thursday and Friday? Thursday, we would have made money in those, and Friday, we definitely wouldn't have made all the money in them. And so the reason I'm sharing that is because people think in the stock market, you can't analyze these things and get a tell.
And it was a big part of this, the shifting quads?
It is. Because what ends up happening is in a shift in quads, what happens in the price of various asset classes, one gets weaker, one gets stronger.
Mm.
And you just need to know the math of how to actually analyze that, but also what asset classes are best in order to determine how to figure that out. And it's just math. And if you have a great process to do that, it actually works. So it happens in the Super Bowl. It happened this week in people's portfolios in the QPM.
So while the Seahawks could read the movements, and really I think what it was the setup of the offensive linemen for the Patriots.
Right.
And they could tell, was it going to be a run or a pass or which way were they going to go? Your QPM can sort of read the market to a degree.
It can.
And understand which asset classes to get into or out of based on the quads.
Right.
Interesting.
I'm looking at the math. I'm expecting crypto to have a huge, huge move sometime in the next week or two. It doesn't fit the quads. It's just looking at the math. Unless they have a big move up for a week and then collapse again. And
I'll tell you what, this is a great lesson for all the young kids out there who sit there and they go to school and they bitch and they moan because they have to do math and they go, when am I ever going to use this in the real world?
Right.
But you might.
You might have to. Now, you know what, Rich? That is just an awesome segue. Just awesome. And if you don't mind, let's skip section 1 and go to section 2.
Okay.
Then we'll go back to section 1.
And apologies to all the people who I offended with my language a minute ago.
Oh, hey,
I'm from New York, though. You have to excuse me.
Yeah, it's all good. So let's skip to instead of number 1, the advantages of Roth. let's talk about how people can use math to simply choose their investments in their 401k or 403b.
Okay.
You just said, hey.
I don't know. I mean, I kind of like the segment, The Advantages of Roth.
We will.
I like that. I like the way that
They're
sounds.
Huge. Your wife wrote that segment for us.
No, she wrote the next one that says Disadvantages of the Roth. That's the one she wrote.
And but realistically, if you use math, I came up with 3 different ways that you can manage your money in your 401k. Because
Okay.
Rich, did anybody call you guys and say that their retirement plan actually gives them advice? Remember last week?
Yeah, I don't believe so. No,
Right.
I didn't hear about it.
I didn't get any calls either. I didn't get any calls from people complaining, or you didn't get any advisors calling you, so that must mean something.
No, I got plenty of complaints, but not about your show.
Right. Well, I'm willing to listen to them, but if there are complaints about my show, let's go. Let's talk about it. But no, normally, we said last week that a lot of times firms who provide the 401k, 403b, 457 do not give the advice of how to invest, because realistically, you're talking to somebody who is running a business. They don't always know, do I do large cap, small cap, mid cap, international? They don't know what to do. You're talking to a lady who she works there, running a department, HR. She doesn't always know what to do. So there's 3 ways you can do it. There's 3 ways that you can pick your investments. Number 1, Rich, is, and I'll try to make these really simple for folks, not because they're not sophisticated, but just so you can remember them. The first thing, and the law actually requires this, is just use target date funds that matches your retirement year, or as close to it. Generally they run at 5-year increments.
Mm-hmm.
So if you're going to retire in 2060, you're golden. But if you're going to retire in 2062, 63, you have to make a choice. 2060, 2065.
And if you want to be a little bit more conservative than normal, you would pick like 2050.
Yes.
Right? Because it's going to be a more conservative portfolio. If you want to be more aggressive, you go a little bit further out.
Right.
Okay.
I was amazed, Rich, when I've analyzed these, that I was thinking that, hey, it's 2026. I want to go real conservative like 2030. A lot of them are 50% stock.
Really? Wow.
I was surprised.
That's not very conservative for retiring in 4 years.
Right. Well, that would be a great conversation for another show, because the problem is longevity risk, and people are living so much longer. I have a client that she was actually one of my first clients, like in 2001, 2002. She had breast cancer, and it metastasized.
Mm.
She went to Tijuana. She's like this holistic kind of person. It's gone. And she's still living and thriving.
Wow.
And so the problem that if she had gone real conservative, she would have had issues, But the first option is use target date funds. Number 2, you could choose 3 buckets. Rich, did I tell you, I like Dave Ramsey. Dave Ramsey, I think, is actually on WLNI. Is it every night?
7 to 10 every night.
7 to 10, yeah. I like Dave Ramsey. He's really good. I don't like his investment philosophy. I think it's choose 5 mutual funds, 20% in every bucket, and just let it ride. The problem is, if you retired and you started doing that in 2006, dude, you got toasted.
Mm.
Yeah, toasted. Because the amount of risk that portfolio takes on, it's all stock. And the amount of risk that it takes on is very dramatic, commensurate to the return that you get. So I don't really, because I used to be a smart investor.
Mm.
And I talked to them. I said, I'm not going to do that. And they were like, well, we appreciate your honesty. We're going to part ways. So I was no longer a smart investor, because that's not the way I do my business. This option is a little different in that you're choosing 3 buckets: U.S. equity, international, and bonds. And what I would do is, if you really just want to do this, choose like the S&P 500 because that takes care of large cap and small cap. Or if they have something that's very similar, I'm going to give you a symbol, IWV. Text me, 434-316-0246 and say, hey, what's that symbol? And I'm going to put this on here, IWV. It's it's the entire U.S. market. It's basically all 3,000 stocks. It's not 3,000 stocks, but that's what they call it. Then do something international. You should probably have an international in your retirement plan that you have, and then a bond fund. And so what you would do there is, if you're moderate, do 25 equity, U.S. equity, 25 international, 50% bonds. If you're moderate aggressive, do 35, 35, and 30. Things such as that. That's how you can do that. And then finally, use a disciplined process. And what we're going to do is it's on our website. You have to go to our financial planning page, and you financial advisors out there, I'm giving you a hard time. Just I'm goading you a little bit. Just use someone else's name. I'm goading you, playing around. Rich, come on, laugh, bro. Come on, come on.
I'm laughing on the inside, Allan.
Yeah, Allan. Please don't call me. Don't call Allan. Call Allan. But go to my retirement planning, retirement income, and you can go in there, and a pop-up will occur. And basically, what's going to happen starting next quarter is we're going to start sending out a free quarterly retirement plan positioning update. Basically, what we do is we do the same thing for clients, but we manage their portfolios. Is we basically talk about the economic conditions, where the inflation is, and based on sector leadership, we will translate that into where to move your target date funds according to where the economy and inflation are going. Basically, the easiest thing with, give you an example is if everything is go-go, it's really good, you do a 2070. If things are getting really, really hairy and you want to go conservative, you basically go to a 2020, a lot more conservative. And just to make it easy. You don't have to do it, but it's a free service that we're going to provide, and you just go there, put your name and email on there, and we will send that out on a quarterly basis and hopefully expand it. And we'll probably do, if you're moderate, conservative, aggressive, and all those areas, that way it can give you an idea, because a lot of folks just have no idea what's going on. Any questions about that, Rich?
So they just go to your website?
Yeah, just go to my website, servuscm.com. And up top, there is a financial planning piece and a investment management piece or link in our thing you click on. I need to learn what these are. And you click and it folds that, comes down, and you just pick the retirement income, and it'll pop up there. And
you'll just tell them which sector, because obviously different retirement plans have different fund choices.
Yeah, exactly. And so what we will do is in the coming weeks, we're going to actually delve down into the top employer plans and some ESOP plans, basically. But realistically, most of them are very similar. And even though you may be at Ariva, even though you may be somewhere else, sorry, Rich, I'm messing it up.
Yeah.
There we go. Sorry about that, Rich. Regardless of where you're at, it'll still apply, and we'll help you achieve the purpose and plan for your life. Now, Rich, we didn't get to talk about it. We'll hit it on down the road, the advantages of Roth. If you can take advantage of a Roth, not take advantage of Mr. Roth, but a Roth, it can be a good thing. Sometimes it's a bad thing, but and I may just post those in the notes section. But folks, give me a call at 434-316-0246 or go to my website, servuscm.com. I want to help you achieve the purpose and plan for your life. And I think that's about it. Folks, have a great weekend. Thankful the snow's gone.
Returns for illustrative purpose. This is not a suggestion to buy, sell, or use a platform. Only will a suggestion occur after a meeting to determine goals, risk tolerance, and time horizons. Investments involve risks and no guarantee of future results.